This video, I'm going to go over the various steps in process accounting. So this first one, they'll all be the BlackRock Steel Company. They'll just ask us different questions as we go through. But the first one says that the BlackRock Steel Company has casting and rolling departments. So the rolling department comes in from the casting department. And during the period, the rolling department completed 12,700 tons, including 800 tons of work in process at the beginning of the period. The ending work in process was 2,000 tons. So how many tons were started and then completed by the rolling department? So I've mapped it out already. So if we come over here, they tell us the beginning work in process was 800 tons. Then this is what they started, right? They received 13,900 tons from the casting department. So again, they're after the casting. So we know that too. So then what is available, I had to calculate. So it would be those two added together. You could also back into it too. So again, the 800 plus the 13,900 gives us what's available. Then they tell us the 12,700 was transferred out to finished goods, and then that left 2,000. So again, you could go back the other way too. So either you add down or you know how it ended, what was transferred out. We must have had 14,700 available. So that is kind of the flow of that. Just the beginning balance plus what we started gives us what's available, less what we completed and transferred to the next level of production leaves us our ending balance. Then these two deal with our equivalent units of production. So there's the equivalent units for the direct materials and then the equivalent units for the conversion costs. So again, we're still in that rolling department. They had 800 tons at the beginning of their inventory. They started and completed 11,900 tons. 12,700 tons were transferred, or no, sorry. So I think I read that wrong. Okay, so they started with the 800, 12,700 tons were completed and then transferred to the finished goods. The ending work in process was 2,000 tons. So then I've mapped it out again over here. So what did we start with? What was started and completed? Again, because the total of those two, the 800 plus the 11,900, is that 12,700. So I kind of just broke it out as compared to how they had it written. And then what was left was 2,000. So then it tells us in here, though, that the materials are all added at the beginning of the process. So then the 800 that we had in our beginning balance would have already had the materials added last month. So what we started and completed, all of those materials would have been added this month. And then the 2,000 that are left, again, if the materials are added at the start, all of those would have been added as well from a material standpoint. So then we have 13,900 tons of equivalent material units that we need to account for. Then down below is the other half of this, is the conversion. So the conversion is the direct labor and the overhead, that we're actually kind of touching the material. In this case, they're rolling it. So once the rolling process starts, maybe there's cooling. I don't know what all goes into the rolling, but all that would be part of the conversion costs. So then we look at, well, okay, out of our beginning inventory, it tells us that those 800 tons were 20% complete. So that means at the start of it, they were 20%. So if we look over here at my formula, that means 80% was added during the current month. So they started at 20%, so 80% was finished during this month, and we have to account for it. Then out of the ones that were started and completed, all of the conversion costs were done in this month. So we have the entire 11,900. Then we go down to our ending, and it tells us that those are 30% complete. So then that is 30%. So then maybe the one that's tricky is your beginning balance. Just know that if it was 20% complete at the start of the month, that means 20% of those conversion costs were last month, and we're not worried about those. We're worried about the 80% that it took to finish them. And then if they were started and completed, that means they were 100% done this month. And then the ending is just the percent that was done this month. So that's the percent that they give us. Then we add those up, and those are our equivalent units of production for conversion. Then the next step is, well, how do we know how much? So those are our equivalent units, but we want to figure out how much we're going to charge to them. So then we look at our total materials. So our cost of our direct materials is $625,500. And it tells us the equivalent units are the 13,900. So if we divide those two, if we look at that $45, I'm dividing the total by those equivalent units that I just calculated above to get to a price per equivalent unit. Then we come over to our conversion costs. Those are 157,600. And then our equivalent units, again, what was computed above, is the 13,140. So then we divide those to get to $12 a unit. Then we come down to applying it. So then we first apply our direct materials. So what we started and completed during the month, the 11,900 times the $45 is $535,500. Again, if I go there, I'm just multiplying those two together. Then the 2,000 that I had in my ending inventory, again, 100% done related to our direct materials. So we'll multiply that by the $45, and that's 90,000. Then those conversion costs, our beginning balance still had 80% to complete. So that is the 640 times our $12 gives us that. The ones that we started and completed times our $12 gives us that. And then our ending inventory that's 30% complete times the $12 gives us that. So then we have it total broken out. And this is the total of everything, direct materials and those conversion costs. And then our ending inventory is the 2,000 at the 45, the 600 at the 12. So then I've just picked out the ending inventory only. So that's going to be valued at 97,200. And then the difference is going to be transferred out. So the 821,200 is our total, less what's left in our ending inventory. So the $724,000 needs to be transferred out. And then down below, then they'll have us do the journal entries. So then, and then here they gave us that beginning cost of inventory. Sorry, I didn't mention that, but going up here, I have it in that very top cell, but that was provided to us. We didn't calculate that. Then go down here and it says, okay, now let's do the journal entries to transfer it, the materials and the conversion costs out to our finished goods inventory, and then determine the balance at the end of the period. So if I come over to our journal entries over here, we have the $625,500 coming in from the casting department. So that they tell us right over here, the cost of the materials transferred into the rolling department from the casting department is that. So then the journal entry would be to put it into work in process rolling and then take it out of work in process casting, because again, it's moving to the next level of production. Then we have our overhead costs that are coming in. And again, they give us those. The conversion cost for the period is $157,680. 94,600 is the overhead applied. 63,080 is our direct labor. So then here the total is coming into the rolling department, and then we're crediting our factory overhead, and then we're crediting our wages payable for the direct labor. Then the amount that we calculated above that we know is getting transferred out to the finishing department, we're going to, or sorry, not the finishing department, the finished goods warehouse, we're going to debit our finished goods for that 724,000 and then credit our work in process rolling. So then what I did is I prepared a T account just to show you the flow. I'm not sure what that number is there. Okay, so I'm not sure what that is. We're going to delete that out. So here we have the beginning balance that again they gave us right here. Our beginning inventory is the 38,020. We transferred in the 625,500 from the rolling department. We allocated $157,680 of labor and overhead. We transferred 724,000 out to finished goods. So then, whoops, that leaves the $97,200 in our ending inventory. And then if you go up, that is what we mapped out above. So I just wanted to show it kind of nicely going into the ledger so that you could see how it ends up at that balance, but it is also the balance that we calculated. So hopefully that makes sense in the flow of how that goes. Then from finished goods, we're going to sell it, and then we would charge it out to cost of goods sold. They don't have an example of that one, or I would have taken it to that next step, but that's the next step after finished goods is charging it out to our cost of goods sold.